Ladies and gentlemen, good day and welcome to JHS Svendgaard Laboratories Limited Q4 and FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikhil Nanda, Managing Director from JHS Svendgaard Laboratories Limited. Thank you, and over to you, sir.
Hi, good afternoon, everyone, and thanks for joining in for the investor conference that we are having on our results this year. And it's a pleasure to welcome you all here. Quick brief about how the last financial year has been. We have very diligently worked in order to improve our margins because that's been a concern area for the last many quarters. And we have managed to get price increases for many of our customers. And whichever we were not able to actually get a price increase, we've dropped out those customers because the most important part is to have a healthy bottom line. Sales can be picked up subsequently, and as we can see, we did have a drop in our sales in the initial quarter, but in the quarter 4, we managed to increase the sales as well as the profitability in the company. We've got some new clients added. Reliance is one of the clients with whom we've started domestic sales to their retail stores, and also the GT, the general trade division that they've opened, is something that we'll be supplying to subsequently because the same products are being approved for the GT sales too. Apart from this, we've also renewed our focus back on exports, which during the COVID times had taken a major hit, and from almost 25% of our sales to 1 or 2% of our sales, the export sales had dropped, which has started looking up again with a decent profit margin. And we have also changed our payment terms there from what we earlier used to supply on credit to documents through bank on a fixed tenure basis. So there's going to be no outstandings and delay payments like we've seen earlier. All in all, we are working to improving our capacity utilization, which is at about 30-35% overall. And some new clients are being added, as I mentioned. And our target is to have maximum capacity utilization, at least 70-80% of it in next 2 years. And this would not involve much of a capex, except certain molds that we might have to make specific to the requirement of our customers. Apart from this, as far as the institutional sales are concerned, we are supplying to the canteen stores, which is the army stores, as well as the CPC, which is the Central Police Force stores also. There also the sales have improved. We've increased the sales and profitability specific to that section by about 40%. And we are trying to introduce new products and grow the sales there also. Apart from this, we have very successfully also got the talcum plant running and got new customers from earlier just single customer, which is Nycil from Zydus. We've also added Amway as one of our customers, given a stable product to them, which is also our formulation and our IPRs. So that's another development with regards to the company. These are the last year's changes which have been initiated. We've also added a few senior team members in our company, which has seen a change in the overall outlook in terms of the deliveries in terms of capacity utilization, in terms of order book. So going forward, we are very confident of improving our margins as well as our capacity utilization with these new customers and the new focus on the export market. Thank you.
Should we begin with the question and answer session, sir?
Sure.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take a first question from the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. Looking at the current new customers that we're adding and the plan to ramp up capacity utilization, what kind of revenues are we looking at in FY25? And what kind of margins, steady-state margins, do we expect to achieve in FY25 looking at the current situation?
So we are looking at something like 30 to 40% increase on the FY23-24 sales numbers, but there's going to be a substantial on the profitability, primarily because we've improved on a lot of parameters, which includes manpower utilization, which includes revision of our contractual rates with our customers, which includes a little reduction in the overall raw material prices, giving us the benefit. So considering all this, added with the increased sales, I think we should be in a healthy double-digit number on the EBITDA margins in the current financial year.
Or it's a healthy double-digit as in mid-teens?
Correct.
All right. Sir, to ramp up from 30% to 70% utilization, I mean, what kind of steps are we taking? Do we have some visibility of any companies joining us in the coming years? What gives us the confidence?
So, as you would know that oral care as a category is about 15,000 crores in India, and it is predominantly dominated by 4 big companies, which is Colgate number 1, Oral-B number 2, Dabur number 3, Unilever number 4. So 4 of these companies, and 5th Sensodyne, which is GSK now, Helion. Together, 5 of these own about 85% of the market. And earlier we had one of 2 of these companies, including Procter & Gamble and Colgate. We've managed to add Unilever as one of our customers in the current financial year, but how most of these multinational brands operate is that they are a little conservative initially. Once the volume and the ramp up happens, then they start increasing the volumes. And secondly, on account of reliance to the full-scale FMCG, we are expecting that there is going to be a substantial increase in the volumes that these guys are going to do, knowing how Reliance normally does to at this time. So this is where we draw confidence from.
All right. So when did our agreement start with Reliance? When did it commence?
Last year, September.
All right. And sir, earlier we used to serve
supply
PNG as well.
Agreement happened earlier. Supply started from September because it takes about 5-6 months for things to kind of develop the product, packaging, all those things.
All right, sir. But since September, we have not seen any significant impact on the volumes. So, I mean, by when do you expect the volumes from Reliance to actually ramp up?
I would say the current financial year, they are also currently only procuring. Mentioned in my earlier speech that currently we're doing it for the retail stores. General trade, they still have to start with the oral care. They've only launched the aerated drinks, which is Campa Cola, in the general trade. So, and of course, soap, Puric, which has been there for some time. Oral care in general trade is yet to start. And that's their internal plan, but we are pretty confident that whenever it starts, it's going to see a substantial jump in the volumes overall.
So what kind of products would we be supplying for Reliance manufacturing?
Both toothbrushes, toothpaste, and mouthwash.
All right, sir. Sir, my last question is that we used to supply to PNG as well. So, I mean, according to you, what was the main reason for that partnership to not go forward?
So, we were actually one of the preferred suppliers for Procter & Gamble when they launched their toothpaste in 2011, which was Oral-B with Madhuri Dixit as the brand ambassador. Unfortunately, the toothpaste bombed very badly in India. But the reason has been very historical. If you see, none of the white toothpastes in India have managed to stand the consumer confidence that Colgate has. In '96, Pepsodent was launched, struggling despite having Unilever's strength distribution. Aquafresh was launched by GSK in 2001-2002. That also they had to withdraw because in the white category they could not withstand Colgate. Indian brands like Ampa, Amar, Anchor came and they just vanished from the markets because in the white nobody could withstand Colgate. Similarly, Oral-B launched in 2011 and had to suffer this. While in the subcategories, there are brands which have launched. GSK took the learnings, they launched the Sensitive, Sensodyne, Dabur and Patanjali started with Ayurvedic. They hold 90% of the market. Colgate, Bata's Ved Shakti bombed very badly, could not compete with this. So when PNG withdrew the Oral-B toothpaste from the market, we had set up a big plant for them, which was US FDA grade plant, and they stopped the production. So subsequently, there were certain disagreements between us, and we had fresh supplies also to them. And subsequently, we reached a settlement which was out of court, on the basis of which whatever bank loans were outstanding to JHS were given out by PNG, and they withdraw the manufacturing rights from us. And that's been the history.
All right, sir. Got it. So, and the guidance that you're giving of about 30 to 40% revenue growth and mid-teen EBITDA margins, are these optimistic targets, or I mean, even if
they are very realistic, they're very realistic. This is whatever confirmations, order books that we have currently. We are going to do better than this.
What is the current order book size?
So we have an order book of about 110 crores for the current financial year.
And by when would do we execute this?
Sorry?
By when do we expect to execute this?
We'll start seeing the numbers from quarter one itself.
All right, sir. These numbers are very heartening. I wish you all the best. Thank you.
Thank you so much. Thank you so much.
Thank you. We'll take our next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Yeah, good afternoon, and thank you for the opportunity. So my question was, why is the company missed out on the manufacturing boom in India given the Make in India movement which has been...
Can you use your handset mode, please? Your line is not very clear.
Is this better?
Can you switch on to handset mode?
Is this better? Hello?
Yeah, go ahead. It's a little blurred, but we'll manage.
Yeah, so my question was, why is the company missed out on the manufacturing boom in India given the Make in India movement and the intense manufacturing activity which has been going on? Is it because of the weak market and lack of volume on the FMCG side, or is there any other reason for the same?
For it, as I mentioned about just 2 minutes back to Guneet, that the market is dominated by 5 players who hold about 90% of the market. And we just managed to get one customer back. And because of our fallout with P&G, there was, I would say, a cooling off period with most of the big brands and international brands, because of which we could not get the contracts from them with regards to oral care. However, having said that, that's the reason we've started expanding our portfolio of products. We've added talcum as one of the categories, and we're going to be adding more categories in the years to come, so that we are a full-fledged FMCG contracting company for all the big brands. And I think this is just the beginning. The boom, the real boom is yet to come. Yes, we are going to be a little behind the curve, but I'm sure we're going to catch up very soon.
Okay. Thank you so much for your answer, and best of luck for the coming quarters.
Thank you.
Thank you. Before we take the next question, would like to remind participants to press star and 1 to ask a question. The next question is from the line of Chirag Jain from Yogya Capital. Please go ahead.
Sir, I thank you for the opportunity. I just missed out on the number which you said to Guneet for the next year. It was 170 crores, if I heard that right?
No. I said 110 crores is the order book for the next year, which is a firm order book. Okay. And we are going to better that in the months to come.
Okay. Sir, also, secondly, I have secondary question. Now, we have added multiple products in detergent and Ayurvedic. So, how is the product we are trying to do? Because something we try to enter into stops also sometimes. So, how is that doing? Something on that.
Sorry, I didn't follow your question.
So, we have a detergent facility, right?
Yeah, so we started the detergent facility as a greenfield project only for Procter & Gamble. This was a 100% buyback arrangement with them. And the facility was put up on their behest for them. And when the I would say the disagreements between us happened on account of the toothpaste not doing well for them, the other businesses also got affected, which normally happens when you are in a relationship with a single company and over dependent. They try to use all the methods to twist small manufacturers. But yes, this is all behind us now. We've also lived through the cooling off period. I think years ahead are bright for us, and we are going to not consciously be over-dependent on one company as we were at that point of time, even if it is one of the world's best FMCG companies. I think we can easily spread our eggs into different baskets.
Okay. Fair enough. Second was on the margin standpoint. We are targeting something around meeting margin for the next year, FY25. So I assume that most of the additional revenue would directly be flowing in to order book, which would be coming out of the operational leverage. Am I right on that?
Absolutely. So it's a multiple factors. We've brought in operational efficiencies. We've reworked our costs from the suppliers. We have also taken price increases from our customers. So all put together with small percentages pooled, we are going to improve the health of the bottom line going forward drastically from where we are. And of course, the fourth and most important part being the increase in the sales, which brings in efficiencies in terms of volumes.
Okay. So you mentioned in your opening remarks about fixing number of data days. So can you share that number with us?
Sorry, fixing of number of?
Data days. Credit period that we give to our customer.
So earlier in exports, we were giving about 180 days credit, which is down to 45. There were a lot of our customers which were at 90 days. We brought them down to 60 days. So our average credit period is now down to, I would say, from a high of 100 days to about 60 days on an average. So we've managed to shave off 40 days in terms of credit period. We've also increased our credit period with some of our suppliers from 30 days to 45 days. So it kind of gives us a leverage both ways.
So I was trying to understand from a broader standpoint. We have been able to decrease the number of credit period we give to a customer. We have also taken the price hike. So is it because of the inflation being cooled off, or we are having some pricing power or exclusive agreements that gives us this power current at this standpoint, which we couldn't do earlier?
See, it's all about contract, about justifying the numbers, because most of the costs are passed through, and it's only the conversion cost which is where you make the money. And we need to consciously reach out to all of our customers, highlighting the various input prices which have gone up, including the labor, including the electricity rates, including the overall cost of running the operation. And we managed to squeeze out certain price increases. I would also say one of the biggest reasons has been post-COVID. There has been an improvement in the sales number, and everybody is seeing a boom right now. So that boom period, people really go along the flow, and they are more reasonable in terms of giving the price increase, which is justified.
Okay. So what percentage of customers we do have pass on that contract?
50%, I would say, are price pass-on contracts, and 50% are fully a fixed contract.
Okay. Thanks. That was all from my side, and the commentary looks very impressive. So all the best for the future. Thank you.
Thank you so much. Thank you so much. Really appreciate it.
Thank you. We'll take our next question from the line of Rohan Mehta, an individual investor. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a good quarter. Sir, just building upon what you had mentioned earlier in terms of adding new customers, I believe Amway and Reliance after Zydus. So, do we invest in reaching out and capturing new customers, or are we getting traction in terms of customers approaching us? Because you also mentioned about a conscious strategy to sort of let go of customers if it starts impacting our margins, to maintain margins. And also you touched upon reducing dependence on any one major customer. So just wanted your opinion on this.
So I'll start from the reverse. We've consciously kept all our customers less than 25% of our sales. None of them would be now more than 25%, like P&G at one point in 2012-13 in 180 crores revenue was close to 70%. So consciously we're keeping every customer below 25%. Not that we are refusing sales, we are consciously making sure that new customers keep getting added. So one customer doesn't cross the 25% threshold. Number two, we are, what was the second thing? Sorry, I missed that.
So basically, sir, is it going to be sort of something to look out for in terms of getting new customers while losing some? So having a gain in a net sense.
So we've got a new marketing team. We've hired some very good young blood recently, and we've started looking at unconventional sales points and unconventional companies which we feel have the potential to be a large player in the oral care. Just to give you an example, Leaford Pharmaceutical has never been they're very good with the pharma side of it, and recently we've supplied 2-3 products to them. About 2-3 years back we started with one product. We've consciously grown them. They have in that small category of specialized toothbrushes and toothpaste been growing very well. So this is one part of it. Canteen store departments, we started very, very small. Now today we have a reasonable chunk in the CSD sales. We are amongst the top 7 brands which are being sold in CSD. So these are the things we are trying to do consciously. Not that we are moving out any customers because they don't give us a price increase, but yes, we are limiting their supplies to a number where it doesn't hurt our bottom line. And we've seen with one of our key customers that they've come back to us saying, okay, we want to grow the business, because the consistency of our supply in the last 2 decades that we've been supplying to them has been 99.8%. So they came back to us for the growth volume also. So I think it's all about a little bit of a wait, because at the end of the day, cost is not the only driving factor in contracting, because 1 day of sale loss is probably more expensive than the full month supplies on cost of the manufacturing part of it.
Right, sir. Right, sir. I think that's a great strategy. Sir, just touching upon the exports also, where you mentioned export share to increase now going forward. So do we have any particular countries or regions in mind over the next couple of quarters? Any sort of area?
So what we are doing is consciously we're participating in a lot of these exhibitions now. Recently there was an exhibition in Mumbai called CMPL, Contract Manufacturers and Private Label Manufacturers show. So we were present there. We had a wonderful traction there. Next end of the month we are going for a show which is for the last 30 years #1 global show for private label sourcing, called the PMLA, Private Label Manufacturers Association, where global buyers come, and we were regular participants till 2008-9 when we were also supplying to both Boots and Walmart. And we stopped the participation because it became very expensive, and then India market was growing for us. We signed up P&G actually in 2009, and they've given us a roadmap from 2010 to 2020, which was 1,200 crore sales across 3 categories of brush, paste, and detergent. So we consciously moved out of participating in export exhibitions and all these things and focused more on the Indian market. There was a boom which was happening. So now all these are learnings that we take along with us, and we consciously making sure that none of these are substitutes, but they are all complements to each other, and we'll continue to work on each one of them parallelly and not sequentially.
Understood. Fair enough, sir. So just toothbrushes, since it's one of the largest share of our revenue, even more than toothpaste. So is there any, your view on considering any change of product mix that might help us, attain the goal of maintaining or increasing margins?
So toothbrushes being capex heavy, higher entry barrier, because of which we are able to also demand a certain premium from the customer. Having said that, the other advantage that we at JHS have is with the 2.5 decades of experience, the kind of product innovation that we managed to do in toothbrushes, because toothpaste came to us only about 15 years back. Initial 10 years was only toothbrushes. So, and there's a lot of innovation that is happening in toothbrushes compared to toothpaste, which I'm sure in the last 25 years all of us have seen. The Colgate dental cream remains as the Colgate white dental cream. The only new product being Sensodyne and Dabur Red or the Dant Kanti from Patanjali. There's not really been any innovation in toothpaste, but in toothbrushes we've seen a lot of innovative products with tapered bristles, with crisscross action, with multi-level trim profile, with bristles trimmed to the shape of your teeth and all these things. So, and this requires a lot of capex.
Understood, sir. Sir, and speaking of capex, you mentioned that our capacities presently at 30 to 35 will be ramped up to 70% over the next 2 years. So would it be safe to assume that till that time we won't be needing any new capex as such?
So as I said, we won't be needing any new capex except for the new molds which could be specific to the customers. So if you would have seen, the handle design is unique to each customer. But that's only about 5 to 8% of the overall capex required for, let's assume, a production line of 500,000 toothbrushes. So we have production lines of toothbrushes. So each production line gives out 500,000 toothbrushes a month. So 5 to 8% is the cost of the mold. The 92% cost is already available with us.
Taken care of. Okay. And sir, the new product categories that we are doing outside beyond oral care, that would require any capex?
Yes, that would require some capex. That will require some capex in terms of packaging lines, because it's going to be unique to each one of the product that we get. Some of the brands sell in pouches, some brands sell in bottles, some sell in pump. So each one of them have different packaging styles. So that's what probably we'll need to invest in.
Okay. Understood, sir. Just one last question, sir. Since the merger with Vedic didn't materialize, any other such merger or inorganic plans on the horizon by any chance?
So what we are looking at definitely is acquisition and not mergers anymore, because the idea of this merger with Vedic was we will complement the product range, and probably the advantage being the common investor between both the companies. But what we've realized is that the basic principle of management has to be followed, which is unity of command. So there has to be a unity of command which emanates from one central point. It could be anybody, and it percolates down to the team, and that's only it's only then that there is clarity of what needs to be delivered.
Understood, sir. All right, sir. Thank you so much. Very helpful, and all the very best, sir.
Thank you.
Thank you so much.
We'll take a next question from the line of Damodar Prasad Agarwal, an individual investor. Please go ahead.
Hello, Mr. Nanda. Good evening.
Good evening.
Mr. Nanda, I am a small shareholder, and I am with regret.
You are as precious as everybody else.
No, but I am not feeling comfortable to invest in your company. I am really very sad.
Tell me, what can I do to make you comfortable?
Because the value of our shares is going down day by day.
Well, market is something that we don't control, but yes, sales and profitability is what we are consciously working on, and we are going to show you results from Q1 of the current financial year. So kindly bear with us. We can promise you on those numbers. On the share prices, we really can't really comment on anything.
And I want to know what is the, please give the light on your Vedic episode. What happened, why they backed out or you backed out? Can you elaborate?
Sure. The coming together of two companies is always a win-win. Whenever there is a win-lose proposition which comes along, I think the mergers or the deals do not work, and that's been the reason in this case also. Having said that, the last gentleman asked me a question, and I'm answering the same answer to you. We are now looking at acquisitions very actively, and we are very confident that in the current financial year, we'll be able to do a substantial acquisition with whatever cash that the company holds currently, and maybe some stock deal.
Okay, I pray God you do as early as possible. Thank you.
Thank you so much.
Thank you. We'll take our next question from the line of Nihal Gupta, an individual investor. Please go ahead.
Hi, sir. Good evening.
Good evening, Mr. Gupta.
Sir, revenue declined by YOY about 0.26%. So could you highlight, is there any reason in terms of the decline of the revenue?
I'm sorry, can you use your hand?
आपकी आवाज नहीं आ रही.
Mr. Gupta? Hello, Mr. Gupta, are you there?
Can you hear me right now?
Yes, please go ahead.
Now is good. Yes.
Okay. So our revenue has declined by YOY. So could you highlight any reason why there was a decline?
Like I mentioned earlier, we have consciously an effort to move out the customers where we were not making profit, and only stick to the customers where we've managed to improve on the margins by taking a price increase or revision in the conversion cost. And that is one of the prime reasons why we lost out on some of the revenues. Having said that, I can say with a lot of confidence that that strategy paid off. We are getting some of those customers back at revised prices, because contracting is a business where if the customer stops business, he stops in like 1 month's time. But if you have to start business with a new customer, it takes about 6 months for all the quality, plant certification, all that vendor code generation. So the sale dip happens immediately while the sale increase happens over a period of time. But we are very, very confident of the steps that we've taken. And as I mentioned earlier also, everybody is going to see the results of our efforts in the quarter one itself.
Okay, sir. So could you give us the details on our segmental revenue breakup that we have?
Komal, आपके पास होगा because I'm not having that right now.
Hi, this is Ashish Goyal. I'll take up that. So in the current financial year 24, 60% of our revenues are driven from the toothbrush segment, while 30% coming in from the toothpaste segment. Rest of the revenues are from the new segment, which is the talcum powder, coupled with mouthwash and tongue cleaners. So that's a split. And from a product mix perspective, that's the changeover also vis-a-vis the previous financial year. So whereas what we were doing almost 57% revenues from the toothpaste segment, this year the major part of that has moved to toothbrush.
Okay. Any particular reason that we have a major chunk of our revenue from toothbrush segment and not from toothpaste segment? And are we taking any steps to ramp up our revenue in the toothpaste segment?
Yeah. So as Mr. Nanda mentioned earlier during the call, that toothbrush being the capital intensive, so generally the decisions are not just driven from a cost perspective, but also from a perspective of reliability and continuity of supplies. So toothbrush is the area where clients have been continuing and sticking with the company. Whereas in toothpaste, that's the region where, because of the better margin perspective, we have to somehow make some of the customers move out. But as mentioned, they have been realigned, they are back in the business. So that is the thing. But having said that, there's a constant effort to also increase the toothpaste segment while keeping into consideration that none of the customers is beyond 25% of our overall portfolio, so that there is no dependence on any particular customer. But yes, there are constant efforts to again regain the business in the toothpaste segment as well.
Thank you so much for the insight, sir. Wish you the very best.
Thank you so much.
Thank you. We'll take our next question from the line of Chirag Jain from Yogya Capital. Please go ahead.
Thank you, sir, for the follow-up. So we are in what segment are we looking for inorganic acquisition?
So it's a broader segment of personal care products only. And once we are actually in a stage where we kind of closed on the agreement, I think we would be able to make an announcement. But right now, we are evaluating and we are talking.
So in toothbrush, toothpaste, or newer products that we are...
Toothbrush, toothpaste, we are already present with huge unutilized capacity. It's a broader personal care range, which includes creams, lotions, soap, shampoos, all of these products.
Okay. So we will be acquiring their facilities and manufacturing for them.
Correct. Along with the contract.
Yeah. Fair enough. So, sir, I missed out on the HUL lead. We added HUL back on for us. So what products will be manufacturing for them?
Close-up toothpaste. We are already manufacturing it for them now. Small volume at the beginning.
So do we have exclusive or it's more on...
No. It's currently more of the growth volumes that we are getting. HUL has their own manufacturing facility. That's another part. Most of the big brands have their own manufacturing for toothpaste, but none of them their own facility for toothbrushes. So not a single toothbrush is produced by Colgate or Oral-B or Unilever in India by themselves. So all three of them produce toothpaste internally as well as externally. So that's another reason why toothbrushes is a growth area.
Okay. Fair enough. Thanks. That answers my queries. Thank you.
Thank you.
Thank you so much.
As there are no further questions, I would now like to hand the conference over to Mr. Nikhil Nanda, Managing Director from JHS Svendgaard Laboratories, for closing comments. Over to you, sir.
Thank you so much, everyone, for attending the conference today. And as I had mentioned earlier, I'm going to reiterate the same commitment to every one of you that the degrowth time or the decline time is behind us. We are looking at a time period where we are going to grow consistently quarter on quarter on the next many years to come, which is going to be both organic and inorganic, but we are going to ensure that we give a consistent growth in the company revenue as well as the profitability. And we would seek support from each one of you the way you've stood by us in the times when we were not doing too well. I commit that the times to come, we are going to do well, and we are going to make sure that each of our investors feels that the management has put in all the efforts which are required to grow the company. Thank you.
Thank you. On behalf of JHS Svendgaard Laboratories Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.